The CPI numbers, or the consumer price inflation for the month of February, has come in at 6.01%, 6.07%, compared to 6.01 in Jan. So it's not looking like a very flattering number. The CNBC TV18 poll expected it to come at 6. There were other polls, notably the Economist poll, which said 5.9. So you will have to say it's a tad higher than what the street was expecting. That's not a very helpful sign, considering that the February inflation is coming even before the war, and therefore it's a bit of a worry. We will look for other details before we invite our guests. We will be joined in a minute by Nikhil Gupta, the economist from Motilal Oswal Financial Services. We will also be joined by Abhishek Upadhyay, the senior economist at ICICI Securities PD, Anubhuti Sahai, the head South Asia Economic Research at Standard Chartered Bank. And we will also be joined by Madan Sabnavis of the chief economist at Bank of Baroda. Gentlemen, and Anubhuti, just a minute before I tell you the other numbers that have come in. Like I told you, the overall headline CPI number has come in at 6.07, a tad above everyone's poll, but just a tad. And the food price inflation has come in at 5.85. That was 5.43 in Jan. Again, that would be a spot of bother, though in February of last year food prices did fall. Then the food price index is down 0.2% on the month. Vegetable index is down 2.6% on the month. Pulses is down 0.1%. So, well, largely it does look like it's core, which again appears to have surprised the market. Let me see if I can give you more numbers before I come to you. Okay. Cereals, 3.95 year-on-year increase. Meat and fish, 7.45 increase. Eggs, 4.1. Milk products are up 3.8. I'm reading out year-on-year numbers now. Oils and fats, 16.4%. That has always been the problem. Edible oils, and that continues to be good. Edible oils and fats are also up on the month by 0.1%, and of course year on year it's up about 16.5%. Fruit 2.26, vegetables is still up 6.13% year on year, but on the month vegetable index is down 2.6. So that's a positive. Pulses up 3% over the year, but I think pulses month on month is down 0.1. Sugar is up 5.4% year on year. Well, fuel and light is up 0.9% month on month, and well, miscellaneous, I still don't have a core number. Miscellaneous is up 6.5%, so I wouldn't be surprised if we have a slightly sticky core inflation number as well. Okay, that's the big numbers. Housing index is up 0.6% month on month. The housing index year on year is up 3.57%. Okay, clothing and footwear is up 8.86. That's a little stiff. And clothing index is up 0.7% on the month. So clothing and footwear is rather sharply higher, both month on month and year on year. Speak about revenge buying, and you can see it here. Let's get our experts. Like I told you, Abhishek, Anubhuti, Madan Sabnavis, and Nikhil Gupta with us. Abhishek, first thoughts? Numbers worse than you thought? 6.07?
So we were at 6%, Lata, so slightly higher. But based on the details you mentioned, I guess the silver lining is that core inflation should be slightly lower than last month, at around 5.8%, which is about 10 basis points lower. It is fuel inflation where it appears to have been a sharp.
The Informist calculation. The Informist calculation is 6% core inflation. Now, obviously, that's a calculated number, but their number comes in at 6% compared to 6% in Jan as well. So I suppose it's steady. How does that square with your expectation, Abhishek?
So we were expecting core inflation to be sticky. Based on our calculation, it is slightly lower.
Okay.
And slight upside surprise in the headline has come from fuel inflation, where there has been a 0.9% month-on-month increase, which is a very sharp increase. I don't know the details, but there are segments within fuel, such as firewood chips, etc., which move in large increments occasionally. But overall, inflation print at 6.1 is higher than Jan, which was in many quarters expected to be the peak inflation, right? So, and if you account for the fact that this inflation number doesn't account for the movement in international crude prices, which has happened since the last time those were adjusted in early November, average, if you look at between early November and now, is around $90 for international crude, which is 10% higher than early November levels. Okay. So, to that extent, this number is understated by assuming a full price pass-through around 30 basis and core by around 0.5%. So it's a worrying number.
Got that. 6.07, though it's only a tad above our own polled estimate of 6% and the Informist estimate of 5.9. It's still slightly worrying that the expectation was it will peak off in Jan, but now Feb is higher than Jan. Anubhuti, from the numbers I read out, any comments?
The numbers are slightly lower than our expectation, Lata. We were looking at 6.14. But the whole surprise has come from food, which really doesn't give us too much of comfort. As Abhishek was pointing out, probably any relief on core could have been a better news, but core remains pretty sticky at 5.95, similar to Jan. And we have to see how, if not in March, then how April inflation plays out, because probably the fuel prices are likely to be revised then. At this particular juncture, the under-recovery or the losses which oil companies are making is probably closer to 15 rupees per litre. So the pass-through can be significant. How it gets staggered, where oil prices stabilize, these will be key factors to watch out for. Having said that, I think in the April policy meeting, it's a given now that MPC will have to revise its inflation projection for FY23 higher. That was even acknowledged by the 3 MPC members who spoke last week. And whether it goes to 5% or it goes to 5.5% in one go, that will be extremely crucial to watch out for. Definitely not a good number, 6%, and really don't see much of a respite going forward. That there is a lot of impending price increases which is yet to be passed on to the economy. Okay,
so you're expecting FY23 to be revised by the RBI up to 5 or even 5.5. Well, today we had a shocker forecast from Nomura saying that they're expecting 6.3, but that is on the assumption of $108 per barrel for crude. Madan Sabnavis, what is your sense? You saw the WPI numbers as well. Even they were above expectation. Administered gas prices will go up from April 1st, and the new formula is likely to be the formula-based increase is also likely to be higher. So what are your fears in terms of how much you may have to revise up the inflation number?
In fact, Lata, for fiscal 23, we are looking at inflation, CPI inflation in the region of 5.5 to 6%. But I'm not quite sure if all this really matters, because finally, I think what matters is how the MPC looks at it. And 4.5, of course, appeared to be very, very bold, I would say, at 4.5%. But even in case they do revise the estimate to 5.5 or 6%, the question is whether they will take any monetary policy action. And as of now, we have this situation where inflation definitely is on the higher side and will continue to remain in this particular region. Now, whether it's 6.1 or 5.8 or 6.3, I think doesn't really matter. We are in for high inflationary times. But the question is that with growth also likely to be affected on account of the developments which have taken place. So we are looking at maybe 25 basis points being shaved off on account of the war. Will the RBI again say that, look, growth is not yet steady, it's not yet durable, and therefore we need to still tarry for some more time before we take any action on interest rates? So I think that will be the important thing when the monetary policy comes up. But as far as inflation is concerned, I think both the WPI and CPI are going to remain in this kind of range for some more time.
Okay. No, as all of you have been pointing out, the worry is that it was all expected to peak off in January. I mean, that Anubhuti includes WPI as well. And what we have seen is that both WPI and CPI, Feb has been worse than Jan. And the bad news doesn't end there. Feb numbers don't have any impact of the war. We will have the impact only in the March numbers and probably most strongly in April. So this is a bit of a worry. But Nikhil, since you have your finger on the pulse of the market, would your reading also be like Madan's, that this number can look bad, but we are a distance away from 6%, and there is mandate for the MPCs only to act at that point in time? You know, if there are 3/4 of over 6%, since we are nowhere in that zone, Reserve Bank will stay pat. Is that your guess?
Thank you, Lata, for having me on the show. Yes, Lata, it was slightly higher than our expectation for February 22, but I do not believe that it would cause a concern for the MPC and it could lead to any rate action by the MPC in the foreseeable future. I've always believed that growth is a much bigger concern in India when we compare India with other major economies in the world, especially in the Western world. Our growth has been much weaker compared to them, and the inflation that we are witnessing right now, it is not led by higher growth or demand push. It is more caused by supply-led issues which are totally external and actually out of MPC's control as well. So I don't think it would make much sense if the MPC hikes interest rates, even if inflation remains around 5.5%. Our official forecast is close to 5.1% for the FY23 full year. But even if it turns out to be slightly higher, say 5.5%, I do not think that should be a cause for the MPC to be more hawkish than what it would have been, say, in December or January.
You know, that is the interpretation you will get if you read Dr. Patra's speech. The last sentence in that Indian Merchants Chamber speech very clearly said that at the moment we have to consider inflation as supply side. But, you know, beyond the point, somebody is buying at that price, isn't it? So there is an aggregate demand. Well, I was qualified in economics by reading Stanley Fischer, and that word always stays with you. Inflation is always and everywhere a monetary phenomenon. Somebody is demanding at that price, and that is why the transaction happened. So to say that there is no demand element is a little tough. But Abhishek, on that issue, you know, there is a K-shaped recovery, which is perhaps accepted by everyone, even if you don't call it by that letter. It's an unequal growth. And inflation is being driven higher because the upper part of the K has monetary power, has the power to set prices and pay those prices. So you still think that Reserve Bank will stay pat, just revise upward, but as Madan and Nikhil are saying, no action from the Reserve Bank?
Well, Lata, so technically monetary policy needs to respond to output gap and inflation, right? And the K-shaped recovery you mentioned needs to be tackled more from the fiscal policy side, which can more efficiently tackle it. That said, if you look at the market pricing currently, the swap markets are assuming a rate hike every meeting starting June, which is roughly 5 rate hikes in the next fiscal year. My sense clearly is, and which other panelists also spoke, the bar for RBI rate hike seems higher, and given that there are stages, before you finally come down to hiking rates, which would include tweaking and changing forward guidance and finally dropping it, adjusting the monetary policy stance. So the earliest rate hike could happen is August and perhaps later. So we stick to view of 3 rate hikes. And I also hope that you already mentioned that RBI can only be forced to act if inflation reaches 6%. That is a ceiling. That is a ceiling where RBI will be forced to act. The risk here is that if RBI begins a gradual monetary policy normalization, the risk that it will lead to tighten rates suddenly and abruptly later is mitigated. So whether they choose that approach is the critical question here.
Okay. How much are you raising your forecast, if any, Abhishek?
So for inflation, we are assuming inflation between 5.5% to 6%, assuming there will be some excise duty cuts and some pass to retail prices. Of course, we are still working with crude below $100. If it is higher, then you need to tweak these numbers. RBI projections were very optimistic, right? So 4% inflation in second half of the year. Even if they are to adjust it higher, it is likely that they will be lower than our and market forecasts.
Yeah, even without a war, 4 was perhaps a tough ask. Anubhuti, you think the Reserve Bank will have the comfort on the external sector to be able to sing a different tune from the developed economies? That was the main theme in Michael Patra's speech, and the governor also has alluded to that in his monetary policy statements, that developed countries' central banks have a different problem, and that's true. They increase their balance sheets much more aggressively, and therefore there is a price-wage spiral in those economies. But can we continue to maintain that stance in the face of rising global interest rates?
Lata, I would just mention that as far as RBI is concerned, they can definitely go at a much slower pace when it comes to rate increases or reduction in overall liquidity surplus. Because the problem is very different when you compare Asia in general vis-a-vis developed markets like US or Europe. There are two different problems. But at the same time, I think the focus which has remained exclusively on growth cannot be maintained for full 2022. I do take your point that, last week all the MPC members were more on a wait and watch mode. They emphasized their concerns on growth. But I think somewhere that focus has to shift towards inflation. Now let us remind ourselves that when we have got these comments from various MPC members, probably we are 3 to 3.5 weeks into this Ukraine-Russia crisis. We still have 4 weeks to go. And I think 4 weeks gives us a good amount of time to assess how long the commodity price disruption can remain, and probably give MPC a better assessment on where the risk lies. Growth risks will emerge. I think that's a given. That's also our view not only for emerging markets but also for developed markets. We don't think Fed will hike as aggressively as what market is pricing in at this particular juncture. But from MPC's perspective, I think somewhere they will have to find balance the risk between inflation and growth. From our forecast perspective, we are still maintaining our view that from August till December, they will have to go and hike rates, that is repo rate, by 75 basis points.
Okay.
I won't be surprised if it gets preponed, if oil prices continue to remain above 100. Our forecast is 5.4%. But if oil stays above 100, we can be looking at an average inflation number of 6%. So risks are clearly there. And I think, as every week passes, probably we can see a more balanced approach from RBI. Okay. Last point, no way we are going back to very aggressive rate increases. The way we saw during 2011 to 2014, 8%, which was the peak in repo. Because as Dr. Patra rightly pointed out, growth is much weaker. Yeah. And that will start catching up. But somewhere the start has to be made, and some rate increases, in our view, is inevitable. Yeah. Timing is only the question, whether it's June or August.
No, actually now we have an inflation targeting central bank in place. So certainly we are not in the 2013 scenario at all. And even current account deficit is perhaps more like 3.5. It's not like in 2013 at 5.5, where we actually saw a run on the currency. Nikhil and Madan, I wanted your growth estimates. Madan, you first. Have you subtracted your growth number?
I think after making adjustments for the war conditions out here, I think we are looking at 7.5 to 7.75% growth for.
After shaving off, so you were more aggressive than the Reserve Bank.
We were 7.75 to 8%. That's almost the same as RBI 7.8. So I'm saying from 7.75 to 8, we're now to 7.5 to 7.75.
Fair enough, not much.
And see, the one thing I think which we keep saying that I think, Lata, what you were talking about, whether the supply side inflation, have we actually done an analysis to say that by keeping interest rates low, have we actually made growth recover? The answer is no, because we have seen that borrowing has not picked up, investment has not picked up. So I think by keeping interest rates low to sort of help growth, that purpose has not been achieved. And we have actually gone into the negative interest rate territory, which I don't think is a good thing for the economy, especially for an economy where we're saying that consumption is something which is retarded.
No, politically very difficult, Madan, isn't it, for a central bank to bring down growth forecasts, which they have to, at least by the 25 basis that you are seeing, and at the same time increase rates or even sound hawkish. It is politically very difficult. They will have to, if it's not possible for a central bank to admit, like me on air, that there is a K-shaped recovery and it is the upper part of the K that's probably pulling up prices. These are not statements that the central bank can make, even if this analysis is correct. So we should perhaps expect them to soft pedal on inflation for a little longer. Nikhil, this doesn't impact earnings, or perhaps it impacts earnings positively, you think? We are going to be in a year where real growth may be shaved off, but nominal GDP will actually increase, and so will earnings forecast, because prices could be increased.
Absolutely, Lata. I think for earnings, what is more important is the wholesale price index, and there has been historical evidences which suggest that as WPI moves up, earnings also witnesses improvement. So yes, you're right. The nominal GDP growth could remain unchanged or could be slightly better, and real GDP growth, we all know, could be adversely impacted if crude oil prices remain at elevated levels for long.
Okay, what's your number anyway? Real GDP growth?
So we are expecting real GDP growth of close to 6.3% to 6.4% for FY23.
6.3. Okay,
yes,
that is a new low. Okay, I mean, I haven't heard the 6 handle. Probably everybody was waiting for someone else to say 6 first. But the lowest I've heard is 7. I've not even heard 6.9. So that's a brave forecast. Abhishek, just to wind up, will the markets react to this number? Where do you see bond yields? Or do you think all the action is after the borrowing program starts in April?
Yeah, Lata, so the real test for bond markets will be in April when the borrowing program starts. A couple of areas which bond market is keenly eyeing is first, whether RBI can adjust the borrowing program and instead of borrowing the usual 60% of gross borrowings, can they lower that amount in order to keep yields in check? And second, in the monetary policy meeting, will RBI be able to make any firm commitments about the extent of demand that they could buy and support the markets? In both these, in terms of both these drivers, I think the risks are that borrowing could be large and RBI may not be able to commit too strongly. So the direction for yields seems northwards only, but for now it should trade range till you get more clarity on these events. And given global conditions remain negative, right? The US bond yields are
yes, 2.07 actually.
Crude prices.
Fair point. So yields could. You're prepared for 7% in April, right?
I would think so, Lata. Yeah, very high.
That's not very far anyway. It's just 10 basis points. Okay, Anubhuti, Madan, Nikhil, and Abhishek, thank you very much indeed for your analysis. The message from the CPI number, like it was for the wholesale price index, is that it is at least 10 to 15 basis points higher than what the market expected. Now, why is this something that is worrisome? Because everyone expected that we will peak off in January on inflation and the numbers will start coming down simply because the base becomes favorable. Base gets higher, and so the difference should narrow. But we are seeing actually a February inflation which is higher than January. The second reason why this is disconcerting is that this has not even started to, reflect the pressures of the Ukraine war. I mean, there is no higher edible oil prices, or there is no higher pulses prices, which will all come as the war impact unravels. So, food inflation is not yet reflecting the war, and all that will perhaps start showing from April or thereafter. Gas prices will start showing probably from April as the administered prices increase. Fertilizer prices could start reflecting in several ways. So we should be in for perhaps upside surprises, negative surprises on inflation, but the verdict or at least the opinion of our experts is that the Reserve Bank will hold on and try and support growth a little more until it becomes very untenable to do so. Growth already having been shaved off by economists, the Reserve Bank also will have to do that, and it will be very difficult to raise rates when you are also bringing down your growth forecast. Finally, we have to stare at 7% plus interest rates come April when the borrowing program starts. After all, the support from inflation is negative. With that, we wrap up on this special edition of covering the February consumer price inflation numbers. Thank you for watching. Keep it with CNBC TV18. Lots of news and updates lined up for you.